Welcome, welcome everyone. Thank you so much for being here this afternoon. We're gonna get started. We do have a few people still trickling in. Feel free to come in, take a seat, relax. Just wanna welcome you again. Welcome to Alumni Weekend. We hope you're having a wonderful time here back at Homewood. My name is Jamie Seward. I'm Associate Director of Lifelong Learning with our Office of Alumni Relations. And I really appreciate you being here. Before I start, I want to acknowledge our co-sponsors, the Finance Affinity and the Blockchain and FinTech Network. Now, before I turn the program over to our moderator, we are going to have the ability to let you ask questions. You may just have to stand up and sort of shout them, but we'll do our best to take your questions at the end of the program. So now I have the great pleasure of introducing our moderator, Professor Jim Liu, Associate Professor of Finance at the Johns Hopkins Carey Business School. Professor Liu revels in pushing the boundaries of financial knowledge and product development, both as an academic and fintech entrepreneur. He has published pioneering research on the intersection of social media, big data, blockchain, and financial markets. In addition to the courses he teaches, he serves as the chairman of the Johns Hopkins Innovation Factory and has received the Dean's Award for Faculty Excellence numerous times. He is on the editorial board of the Journal of the British Blockchain Association, the Journal of Alternative Investments, and the Journal of Portfolio Management. He's also the co-founder of SOCAT Consulting, LLC. SOCAT creates award-winning world-class machine learning, AI, and blockchain products and services. Professor Liu holds a BA in mathematics from the University of Chicago and a PhD in finance from Columbia University. Please join me in welcoming Professor Liu.
Thank you so much. It's a real honor to be here, Jamie. I'd like to thank Johns Hopkins alums. This is for you guys so that you can learn a little bit more about blockchains and some of the really interesting developments that's happening. So this is for you guys. We have some really talented professors up here, and we're going to have a conversation about cryptocurrencies. And what we're going to do, hopefully, is start, just assume that there's some people here who have no background in blockchain. So I'll just ask each of the panelists to make sure whenever they introduce sort of technical terms to give the layman's interpretation as well. So what we're going to do, we're missing one panelist, Alessandro. He should be here anytime soon. I think he's gassing up his car. We'll start at the very end with Howard, and we'll have some self-introductions. And I want to know a little bit about, who you are, what part of the Johns Hopkins community, do you serve right now? And then when was the first time you got exposed to, say, blockchains and cryptocurrencies? So I'll hand it over to Howard to kick us off.
Thank you. Most importantly, I'm a graduate in 1972 of the School of Arts and Sciences, and this is my 50th reunion. So like most of you, I'm an alum. Old guard. For most of my career, I was a partner at the Gibson, Dunn & Crutcher law firm, where I was co-head of the firm's global corporate practice. Before Riggs, I was executive vice president and general counsel of Riggs National Bank, which was the largest bank in Washington, D.C. After I left Gibson Dunn at the end of 2017, I served for 2 years as Deputy Assistant Secretary of the Treasury for the Financial Stability Oversight Council, and that's where I became heavily involved in cryptocurrency. After leaving Treasury in 2021, I've written a couple op-ed pieces about cryptocurrency, and I've recently, along with my friend Alex Pollock, written a book entitled Surprised Again, The COVID Crisis in the New Market Bubble. It's going to be released in August by Paul Dry Books, and it's available for pre-sale on Amazon. The longest chapter in the book is about cryptocurrency. So if anyone is interested in what I really think about cryptocurrency, a lot of it is in that book. Thank you.
Okay, excellent. So Alessandro, who's coming in a little bit late. So the question is, we're just introducing ourselves and talking about, what role do you play in the Johns Hopkins ecosystem? And then, sort of when were you first exposed to cryptocurrencies?
Good afternoon, Jim and everybody. I apologize for being late. Electric cars are a great innovation, but as every new technologies, they have glitches, and I got stranded. So I am associate professor at the Carey Business School, where I teach financial institution, macro international finance. Before that, I spent the first part of my professional career in international financial institutions at the IMF, at the Inter-American Development Bank. I first got interested in fintech when I joined Carey, and I was teaching financial institutions. We were starting to talk about fintech, and I pushed to my student that that was an important area to think about and to start to develop skills, because it would have boom. That was pretty much before anybody else was talking, including academia. But I decided not to pursue as a research area, but I kept following and keeping an eye, because cryptocurrencies have a lot in common with exchange rates. And a couple of years ago, when the debate got heated, I focused on blockchain, and I wrote a piece where with some co-authors, we suggested that blockchain could be used, for example, to develop an international patent system. The global patent system is very fragmented. Essentially, everybody relies on the US, and blockchain could be a platform on which develop something much more useful to innovation and technology more broadly. And I am an observer of important new developments, and in particular the regulatory debate that is taking place. And I'm glad to be here, and again, I apologize for arriving late.
Oh, thank you. Thank you so much. So for full disclosure, Alessandro, Nicola, and I are all from the business school. And I think we're all in finance and economics, right? So I think you're overrepresented here on the panel discussion from the business school, but that's great. We have somebody who's been at Johns Hopkins for some time. And if you've ever seen Coursera, you would recognize Brian. Brian, you want to introduce yourself and tell us sort of how did you fall down the blockchain rabbit hole? And for full disclosure, Brian and I, we have a conversation maybe once every 2 or 3 weeks, and we discuss cryptos in depth, and it's a lot of fun having conversations with him. So he's very knowledgeable about this space. Brian?
Thank you. So hi, my name is Brian Cat. Well, first I would say welcome to all the alumni. It's great to have you here. It's wonderful to see you. My name is Brian Caffo. I'm a professor in the Department of Biostatistics in the School of Public Health. I have a secondary appointment just over there in the School of Biomedical Engineering. What I do mostly for my day job is I sort of work at the intersection of where neuroscience and statistics and computing and topics like that all intersect. And I really quite enjoy it, and Hopkins is a wonderful place to do that kind of research. In addition, I run a supercomputing center called the Johns Hopkins High Performance Computing Exchange, where we provide supercomputing for medical and biomedical research, primarily on East Baltimore, but throughout the whole campus. As Jim mentioned, with 2 other faculties, we created the Coursera Data Science Specialization, which was a 10-course specialization on Coursera. My interest in crypto started in maybe 2017, and I think I'm probably up here the rabid enthusiast representative. So I've been heavily reading about it and involved in it, though I think I would declare myself as the non-expert among the panel.
Okay, and last but not least, our star faculty in finance, Nikolai. When I first met him, he was sort of, actually interviewing. And so I got to interview him and watch him, on board into the Carey Business School. And he's one of our, leading star, faculties. So it's just so great to have him. And I always bring him in on these panel discussions. And he's like, what are we talking about? And I'm like, Nicola, we're going to talk about blockchains. He goes, okay.
Well, thank you, Jim. Of course, you should take whatever Jim says, cut in half, and then cut in half again, and then you get about right. So it's a pleasure to be here. As Jim said, I'm associate professor at the Carey Business School. My research revolves around managing risks, volatility, derivatives, and bubbles. And so you can think that cryptocurrency, right, just like grabbed my attention from the get-go. Jim was kind of probably one of the first guys who came to me very early on and was like, what are you talking about? And then in 2017, when you had, Bitcoin prices skyrocketing, that's when really I started thinking about it and what it means and what they are. And like, the volatility that was embedded in this asset just like grabbed my attention. And since then, I never wrote any piece on it, but I constantly follow the market and as it evolves. Possibly more skeptically than
Brian.
Brian.
Okay, so this is a really interesting combination of professors, some who are very bullish on cryptos and some who are sort of very skeptical. So we're hoping that there's going to be a lively debate here about the merits of cryptocurrencies and also the risks. So we're going to have a nice discussion. But before we really get into it, I think we need to level set the conversation, right? So, you know, there's blockchains and there's cryptocurrencies, right? How should we sort of first define cryptocurrencies? And, you know, can we agree on a common definition? And from there, we're going to jump into some discussions about the regulatory issues, the risks and the volatilities and so forth. But, you know, for you, anyone can answer, you know, what is a cryptocurrency? How should a layperson think about this? Anyone can answer that.
I'd be happy to give the lay definition. So a blockchain is effectively a database, and it's an immutable, time-ordered database that is public and updated by a collection of so-called validators. The cryptocurrency, in essence, is a unit that sells block space. So when we talk about something like a layer 1 cryptocurrency, that is the cryptocurrency that governs this database and sells the block space. The block space is itself a ledger that allows people to perform transactions. The initial blockchain was Bitcoin, and the primary use case for it was to just transact the cryptocurrency itself, Bitcoin, to exchange between people as a store of value or as a currency. The reason it gets its name cryptocurrency is because in order to prevent bad actors on the blockchain, the validators would need to solve a small puzzle in order to create work, in order to make it hard to update the blockchain so people wouldn't do it superfluously. Since then, blockchains have been updated so that the modern blockchains have things like smart contracts, so what can go on the block has been greatly expanded. But if you want to reduce the definition of a blockchain down to its bare essentials, it's a public, trustless, ordered database.
So just to try to put that a little bit more simply, in the old days, if you want to buy a piece of property, you went down to the county clerk's office and you wrote it in the book, and there was a record of it, and it existed, and somebody would dust it off, and that was your record. Blockchain provides a way of making a record for financial transactions that is blasted out to the world. It exists on many people's computers. It is replicated, and it becomes an immutable proof that a transaction has occurred, and it's done without, in its purest form, it can be done without any intermediary. It just occurs. So it makes my story of the county clerk look and sound as antiquated as I tried to make it sound.
It's interesting that just defining blockchain, cryptocurrencies, and decentralized finance application is very hard. So let me share how I think about it. The blockchain is a technology, from my perspective. Yes, is a technology. And the distinctive feature is to be an electronic computer-based ledger, so a database, as we were mentioning a minute ago. And the key distinction is that the certification of the authenticity of any transaction is decentralized as opposed to be centralized. So we can think about our financial system as being dominated by being centralized. So we have institutions that settle transactions and verify transactions. We have a central bank that, for example, has a monopoly of issuing currency. A blockchain-based system is a decentralized system, in principle self-governing, so proof to be tampered with, to be manipulated. As you know, central banks can create a lot of, can issue a lot of money and create a lot of inflation, for example. So that's why one of the reasons why proponents of cryptocurrencies are very excited about that. But the key fundamental distinction is to be a decentralized system, in principle self-governing. And another important feature that is technologically complicated. So we have a hard time defining. So imagine building application, imagine applying, using application, knowing what we're doing. So that's one key obstacles to the further development and diffusion of these potentially very useful technology.
Yeah, my more skeptical view is, so I think the main distinction between centralized and decentralized, let's bring the point home. The way I see the blockchain is also as something with a set of rules that blockchain has to adhere, or players in the blockchain needs to follow. And this is where the distinction between centralized and decentralized comes into play, as well as a possible negative side. While in a centralized market, it's very easy to change the rules because there is one main player that can decide the rule. In a decentralized market, changing the functioning rules becomes way more complicated. And so you are in a system where the rules are set very early on. And my skeptical eyes are always thinking, what are the chances that you were able to set those rules optimally since the very beginning? And as time goes by, you realize that something could be done better, but now changing the rules becomes extremely complicated because you need to convince more than 50% of the player that the new rule is better than the previous one. And we had examples in Ethereum and in other instances that these changes are very difficult to achieve.
Absolutely, I appreciate that. And it's actually really interesting to sort of look at the history, right? So first we had Bitcoins, and sort of Bitcoins wasn't enough. So, you know, some Vitalik Buterin said, hey, we need smart contracts. And then he innovated on top of Bitcoins, right? And then people who were the founders of Ethereum said, you are moving too slowly. So they left and they started, Polkadot and also Cardano. So we're seeing a lot of entrepreneurs leaving certain projects because they think they can do it better and faster and safer and so forth. But, you know, we're sort of at this place right now where cryptocurrencies are becoming very, very popular. You know, just as a way of audience participation, how many people in the audience right now, the alums of Johns Hopkins, how many of you guys have any cryptocurrencies just by raising your hand? So that's a pretty good number, right? Maybe like half-ish. So we're beyond the early adopters. One of the questions that we have here is, you know, why is it so popular amongst retail investors and starting to become more popular amongst institutional investors? You know, but why is it so sort of seen, the economists and the regulators are still very skeptical about that? What are some of the risks that, you know, the average retail investor should be aware of when it comes to this technology, cryptocurrency? Anyone?
Okay, fine. I think the two greatest risks that cryptocurrency faces right now are the risk of regulation, and the greatest growth industry in the country is probably cryptocurrency lobbyists. So I think the cryptocurrency industry sees that as a risk as well. And I also see a risk coming from competition from central bank digital currencies. Many countries throughout the world are considering whether or not to issue, in effect, their own cryptocurrency through their central bank, which is government cryptocurrency. The Chinese are quite advanced in it. They have a digital yuan, which has been rolled out. Bahamas has a already rolled out sand dollar. I think hundreds of countries are looking at that, including the United States, the digital dollar. Now, if central bank digital currencies become very common, it's very, very difficult to compete with the United States government or any major government because they don't have to show a profit. It's hard for private companies to compete with governments. And I think it's very, very, you got from the answer to what is blockchain, Blockchain was basically, and cryptocurrency is basically started by a group of people who were very skeptical. They're anarchists. They were very skeptical of central authority. And I think one of the great ironies that that you may see being played out is that the whole thing may ultimately be captured by governments and central banks, which is the exact opposite of what the crypto entrepreneurs and founders, you know, Satoshi Nakamoto, the fictional person who came up with the Bitcoin manifesto. That's the opposite of what they set off to do. So I just throw that out.
Yeah, my view on this is that when we think about investors and academics, for example, how they think about this, I think investors, they care about returns. Academics thinks about risk-adjusted returns, and that makes a lot of difference. Like investors, I think, especially retailers, they are very good, possibly in a bad way, in extrapolating return. They're saying, well, this asset has been doing very well in the past, it's gonna do very well in the future. When you're thinking about the risk-adjusted rate of return and you take into account all the possible risks, regulatory risk and so on and so forth, as an academic, I start basically discounting that massive increase in prices that you see. So I'm not surprised that there is this kind of disconnection between what Main Street thinks about cryptocurrency and what academics might think about it.
So I'm not 100% sure how I would characterize why it's popular, but I think it's easier to characterize the risks. If you're a retail crypto purchaser, it depends heavily on where you keep it. You know, if you purchase from a central authority like a centralized exchange, then there's the risk of whatever, you're not technically holding the crypto. The exchanges, there's regulatory risk. There's, if you hold your crypto in a cryptocurrency wallet, there's the risk that you lose the funds by some sort of mismanagement, since all the guardrails are off. Depending on the kind of cryptocurrency you own, if you're owning a stable coin, there's a chance that it may lose its peg to the currency it's trying to mirror. There's I think risk, what I would describe as intrinsic smart contract and platform risk associated throughout crypto as you engage with it. As to why it's popular, I think it's popular to different people for different reasons. Some people are highly interested in the decentralized aspect. There are other people who are quite interested in the technology, other people who are in it primarily for returns, and other other tokens, meme tokens and things like that, where people are in it for the fun.
Yes, so the way I think about this is on the backdrop of both what finance and money historically has done to society. So we need money as a medium of exchange, an economy in which there is a medium of exchange, an economy that functions much better than a feudal barter system. And financial institution allows borrowers and savers to meet and essentially trade. Savers have more resources than they need, and borrowers, they have less than they need. So finance fulfills some important function in society, and blockchain has the promise to fulfill it better. I gave the example that I thought about, which is replacing a fragmented international patent system with a global blockchain base. That would be a great idea. Blockchain promises to potentially reduce liquidity and default risk in the financial system, to lower the cost of domestic payment or international transfer. So all these potential are great, but they're not yet realized. Gary Gorton, I recently heard him talking, is assessing the degree of development of this technology to what internet was in the 70s. So we are probably 20, 25 years away from the technology realizing these potentials. So why investors are excited and economists are skeptical? Because economists tend to see all the obstacles to go from here to there, while investors over the past 5, 10 years have had scarcity of opportunity to invest. It's difficult to make any money in the bond market. Yes, there are equities, but Bitcoin has seemed to promise even more stellar returns when everybody's actually having a hard time making any return with regular portfolios. So the type of applications that are circulating, they're really not delivering real benefits as historically money, lending, borrowing have done. They're pretty much bubbles that can be traded, as Nicola was saying, and that is very exciting as long as there is a lot of liquidity around. You can lever up 100% on some of these platform and application, and in the short term make some return. Economists see fundamental problems. Probably the biggest one is the tension between the greater benefit of anonymity, but also the difficulty to enforcing basic regulation in terms of anti-money laundering and financing for terrorism. And now we see with the Russian sanctions. So that's one basic trade-off that the existing financial system resolved pretty decently. But blockchain has a hard time to do. And there are a number of other issues that maybe we're going to touch upon. But there are a number of obstacles to realize this potential. And right now, what is exciting is the fact that some people made some good return without adjusting for risks so far. And that creates a lot of excitement. My son holds cryptocurrency, but I would never touch it.
That's really interesting that your son's holding these cryptocurrencies. So, you know, as a finance professor, I think of risk and rewards, and I've been trained a certain way. So every time I look at my cryptocurrency, you know, it moves up and down so much, I get an ulcer. And then I was like, why am I, you know, getting so stressed out about this investment? Then I thought to myself, okay, I'm going to buy this Bitcoins and Ethereums for my daughter. I have 2 daughters for their retirement. And then I went to sleep at night, you know, very calmly. And, you know, so it's about your horizon. So, you know, it is very volatile, absolutely, probably more volatile than the things that we analyze in traditional investment space. But it's also the opportunities and also the sort of new technological shock. And I think one of the things that's important is, you know, in our lifetimes, we don't see too many big shocks of technology. And when you do see that shock, then you see a bunch of new companies come out of it. And so, you know, there's a great story about Web 1.0. That's when we all got introduced to the email. Could we have fast forwarded and seen Google and Amazon and Facebook and Netflix? No, right? So, you know, that was Web 1.0. Web 2.0 is Facebook and sort of social media and on the mobile phone. All the value accrues to Zuckerberg and the shareholders. So the value is accruing of the network to a centralized sort of players, the shareholders. So now we have another shock, which is Web 3.0, and this is because of the blockchain and because of all these wonderful things. And the question is, how much opportunity is going to be there? It's almost like we're moving this digital value around like we moved email, right? And we don't know exactly how this is all going to play out. But I think the shock has already hit the system. You have a tremendous amount of talent in this space looking for, you know, business models that are sustainable. But what's so fascinating is I think the business model is going to be more distributed. So the value of the network is not going to accrue to some centralized player. It's going to accrue to the network. And so for example, there's no centralized player in Bitcoins, yet it's very successful. And the more people who use it will make it more and more successful, right? And that really challenges most of finance and business because we're always talking about shareholders and centralized sort of players and owners of these businesses. But, you know, sort of talking a little bit about ways to get exposure to Bitcoins, right? You can buy the actual Bitcoins on your wallet. You can open up a futures trading account and, you know, get exposure to Bitcoin's futures. And also people are trying to create ETFs. So one of the questions is, you know, how do all these prices sort of stay together? What's happening here? You know, you have a lit market, which is the exchange ETF. You have the derivatives market, which is the futures. And then you have the, you know, the traditional original market that anybody can play with. So, you know, what are some of the implications here now that we're seeing financial engineers creating more and more of these products?
I can take this. I think that this question will take me like probably an hour to just go through. So I'll go through the basic episodes that I think are relevant to shed some light. So I think there is a huge interest from investors to all cryptocurrency. And this is by all means, okay, if you want to diversify your portfolio, I think we should always looking for assets which are uncorrelated with markets that's going to help you to, even if they have high volatility, they have low systematic volatility, which is potentially good. But as Brian was saying, there is a lot of risk in holding Bitcoin through, for example, just your own wallet. We lose passwords every day. If you own them through an exchange, there is a risk of hacking and Bitcoin or cryptocurrency disappearing. So this kind of concern was mitigated by the introduction of Bitcoin futures. This was like 2017, 2018. In Chicago, the two big markets, the Chicago Mercantile Exchange and Chicago Board of Option Exchange, they both started issuing futures on Bitcoin. And the best example of how you can actually price that holding risk was the following. At that time, Bitcoin was trading for around $17,000. The future on Bitcoin with very short maturity was trading for $18,000, which was $1,000 gap. Those two prices, if you have the equivalent for pork belly, it would be zero, right? For short maturity, the price of the future and the price of the underlying of the future will be extremely small. That $1,000 you could think of as the price of people peace of mind of having Bitcoin in a future contract held by the exchange, so zero risk of losing those money, and the alternative, which was holding the Bitcoin in their wallet with potentially technological risk. So 1,000 over 17 is like 6-7%. That was basically the price of technological risk back then. Now this went down lately, but there's still a little bit of gap. So I think that was one important aspect.
Yeah, that's really interesting. You know, Coinbase's business model is based on sort of this convenience. I don't want to deal with my private key because I might lose my private key, and then what am I going to do, right? So what's really interesting is how this technology is challenging us human beings, right? In terms of do we want that responsibility, or are we willing to pay someone to take that responsibility away from us? You know, one of the things that when I first started doing research in cryptos, I was always kind of bashing the regulators. I said, why are you guys regulating this thing so hard? Just let it be free and let entrepreneurs do their thing. But then I started thinking about how, you know, what is the role of regulators and what are they're supposed to be doing? And then the internet covers the whole world. I think there's not too many countries that don't have exposure to the internet. And now you have a mechanism to move digital value across borders, right? But then you have different countries like El Salvador that legalize Bitcoins. And then you have other countries that may sort of have a sort of negative view on the cryptocurrency. Now, I think there's this tension, and I'm really curious to sort of understand, you know, first, you know, what are the different regulatory regimes across the world? And sort of where does the US sit on the spectrum of, you know, making it freely available to anybody versus sort of completely regulating it and clamping down so that nobody in the countries can, you know, maybe do mining or trade Bitcoins and so forth. So, and then, you know, what are the implications to that particular countries, especially to the people of that country? Is it holding them back in any type of way?
Let me try to take a first stab at that question. Really, the question on how you regulate cryptocurrency comes down to, it really depends largely on how you answer this question. Should currency be a state monopoly, or should private currencies be free to compete with the state? Remember that our first currencies in the world were private currencies. In the 12th century, you could take something of value, deposit it into a Knights Templar a house in one country, and withdraw the equivalent value in Templar specie in another country. The Renaissance was funded by notes issued by private banks in Amsterdam and in Italy. The United States was funded in the 19th century by notes issued by private banks until the National Bank Act of 1864 established the greenback. And you've seen various approaches. You've seen China take the absolute status. I shall say there are a lot of monetary theorists have written about this. My favorite, Friedrich Hayek, in 1976, wrote that people should be free to choose their own currency. So China in 2021 took the ultimate statist, non-Hayekian, if you will, approach to regulating cryptocurrency, and they now banned it. The only cryptocurrency that would be allowed is the official state Chinese cryptocurrency, the digital yuan. We just saw this week Thailand take an intermediate position. Crypto is fine to invest in, but it can't be used as a medium of exchange. The United States is a very fragmented and patchwork financial regulatory system. Right now, some aspects of cryptocurrency are regulated, some aren't. There's a multiplicity of agencies. The Commodities Futures Trading Commission has declared it to be a commodity. They have some disclosure and anti-fraud authority. The SEC, it may be worth just talking about. It's a particularly silly regime, but it's based on common law. They don't have a statute, and so whether they can regulate cryptocurrency, and they're trying to be very aggressive about it, is whether or not cryptocurrency is a security. Whether or not it's a security depends upon the a test set forth in a 1946 Supreme Court case called SEC v. W.J. Howey, which dealt with real estate developers in Florida, nothing to do whatsoever with cryptocurrency. Very fact-specific test, and it basically usually comes down to whether or not profit is being made by a third party. Bitcoin under that test has been declared not to be a security, and thus the SEC can't touch Bitcoin. This is a problem because the government feels that you need to regulate Bitcoin for three reasons. One, it's been used to finance numerous criminal enterprises, including ransomware. Two, there have been various instances out there where developers have committed fraud and excesses that are the traditional things that financial regulators regulate. And three, and this is really the most important, and it's not evident, is that they want to protect the primacy of the United States dollar. The dollar is the world's reserve currency. 59%, ever since Bretton Woods in 1944, it's been the world's reserve currency. The 59% of the currency of the foreign currency reserves of foreign central banks are held in U.S. dollars, and they're mostly held in the form of U.S. treasuries. And that means that there's a tremendous demand for U.S. Treasury securities, and that in turn keeps the interest rate on those securities down. And that's, since we use treasuries to fund our economy, that funds, that basically subsidizes our economy and the standard of living of everyone in this room, every American. In the 1960s, the French described that as an exorbitant privilege, and they're right. So the government's very concerned with protecting the primacy of the U.S. dollar. President Biden recognizes that we need legislation to come up with some sort of a regulatory fix. And a couple of weeks ago, he created an executive order which asked a group of federal financial agencies to consider comprehensive regulation for cryptocurrency under the direction of the Treasury. Which direction are they likely to be headed? There's some clues to that. In November, the President's Working Group, another group of financial agencies chaired by the Secretary of the Treasury, basically put out preliminary recommendations for regulating stablecoins. And they basically took the view that stablecoins should only be issued by regulated banks. They should be subject to FDIC insurance. They need capital requirements. They need liquidity requirements, and that will create a very large bureaucracy. The power to regulate is also the power to destroy. And if you regulate these things too tightly, you're not going to have an industry. And I'm afraid that this kind of regulation may very well wipe out the profitability of cryptocurrency. The Europeans are taking a more sensible approach, I think. And we don't know how the U.S. is going to come out on this. This is just what I see reading the tea leaves. And this will all play out over the next 2 years or so. The EU just had one committee pass its MiCA regulation last week. Again, the beginning of a 2-year labyrinthine bureaucratic process. But what they're proposing to do is to come up with a system of regulation that, one, preserves innovation, and two, protects consumers. I think that's a very sensible approach. It's difficult to to realize that kind of approach. It's tricky, but they would propose that crypto issuers be licensed in one company, have a governance standard, a capital standard, then they could export their business into other EU companies, and they'd all publish a white paper, which is a long disclosure document, which describes the risks and the business that they're selling. So the consumers have an idea of what they're actually investing in. I think that's a pretty good approach, and I think but it has risks. You talk about Bitcoin. Did you know that Bitcoin was almost outlawed last week in Europe because the MiCA regulations up to the very end had a provision in there which this came from climate activists that any cryptocurrency that was based on proof of work, Bitcoin miners validating each node in the blockchain, takes a tremendous amount of energy. And the green activists in Europe wanted to just ban it. And that came out of the draft at the last minute. But that would have had, well, can you imagine what that would have done to the price of Bitcoin? That when China outlawed crypto, Bitcoin fell 22% that day, incredibly volatile. That would have just knocked the bottom out of Bitcoin. It was just averted.
Yeah, I think it's interesting how each country thinks about how they're going to regulate Bitcoins and how much they want to embrace it, how much they don't want to embrace it, and so forth. But in the last sort of 3 minutes before we open it up to questions from the audience, I just want to hear a little bit of your guys' prediction about the future. We have a lot of really interesting, things going on globally. Russia and Ukraine's the war there. COVID is, half of us have masks and half of us don't, right? We also have two other things that we didn't really talk about, but non-fungible tokens in the metaverse, and we're seeing a lot of companies starting to position themselves to capture this opportunity. But in the last 3 minutes, can you look into your crystal balls and give us a little bit of guidance on where you think the opportunity is, and where do you think the risk is, and what should we be paying attention to as the future is approaching us?
I mean, my view probably it's very, very easy to understand. We need to distinguish between cryptocurrency and blockchain. Blockchain is a very promising technology, and I don't think it's going to go anywhere. It's going to stay, and we just need to find a way to use it in the right way. Cryptocurrencies, I'm a little bit more on the fence on that. We spend in finance a lot of time trying to put a price on things, and even on things that we use every day, put a price on a stock. It's incredibly hard. What is the right price on Facebook? If you ask 100 people, they're going to give you 100 different prices. And when I think of what's the price of Bitcoin, I can get any number between 0 and plus infinity. So I'm very uncomfortable with such a big range. So that's my mind.
Yeah, so I'm most enthusiastic about the future of smart contract platforms. So this would be things like Ethereum and Polkadot and Cosmos and Cardano and things like that. One thing I wanted to follow up a little bit on the regulation. I've always been interested in stablecoins and stablecoin regulation. And it's interesting to think about, there's different ways that you can create stablecoins. There's ones that are sort of a bank model where a bank issues a stablecoin, and there's others where the stablecoin is backed by cryptocurrency itself, and there's others that are algorithmically governed. So when the stablecoin goes above $1, let's say if it's tracking $1, they issue more, and if it goes under $1, they burn some, and so the coin is algorithmically via supply and demand curves pegged to the dollar instead of through an entity holding $1. And it is interesting to think about, and of course you can then peg it to anything else. You can peg it to equities, you can peg it to commodities, you can peg, and this is already done. What's interesting is to think about how to regulate these more exotic variations of things like stable coins. And so as far as my understanding is concerned, right now, if you were to, for example, issue a coin that tracked an equity where you held the equity, that would be illegal. But if you issued an algorithmically rebasing token that mirrored an equity, that would be fine.
Well, the president's working group on stablecoins has basically come up with a one-size-fits-all approach. Every stablecoin should come through a bank. And if that stands, I think it's going to, as I said, I think it's going to play havoc with the business model of the industry. And But the great thing about government regulations is every time one gets enacted, there are clever people who immediately find half a dozen ways to avoid it. I'm sure that will happen as well. So that used to be my business. But,
So I share Nicola's view that if we distinguish between the technology and the application, it's clear that technology is here to stay. But again, my sense is that we are quite far. For example, in the 1970s, we had about 200, 250 internet protocols that could not communicate to each other. It was until several years later when technological advances allowed them to communicate that the internet actually took off. Today, we have about 250 or so blockchain protocols that don't talk to each other, they're not scalable. So we need to have that kind of leap forward from a technological perspective. As far as regulation is concerned, I share our concern that bad regulation can actually hamper the development of an industry. My sense that the US has been light touch relative to other countries, not necessarily as draconian as I was hearing. There are many different reasons why these this space need regulation, starting from the trade-off between anonymity and societal need to fight certain activity like money laundering, terrorism, and so on and so forth. But there are a number of other economic issues. So for example, blockchain promise democratizing the financial system, but we already see tendency to aggregation. Most of the transactions are in few exchanges. It promised to have self-governing system, but people research that as I analyze how actual governance takes place, we see the same type of pattern and distortion in corporate finance that we see in traditional finance. So the sooner we regulate, the better. The challenge is to have the right type of regulation to support the industry as opposed to just clamp down on the industry. And here, one suggestion advanced recently by Antoinette Schauer from MIT. The idea is to try to regulate at the entry point at the level of the developers. So the developer would have different disclosure requirement than the users, and they would be the guarantors for the legitimacy of the transaction, and also the possibility to have a shared protocol with other countries and possibly different type of international protocols, those that are compliant with anti-money laundering standards and those are not, and then essentially the industry would self-select in different type of technologies. But it's very important to regulate in the right way early. I think we can see with the FANG stocks, once the industry overgrows and get too big to regulate, there is societal losses that cannot be recaptured with ex post regulation or intervention. So this is an important piece of technology, is here to stay, but it's important to get regulation right as soon as possible.
Thank you, Alessandro. So now, shall we open it up for questions from the audience? Well, okay, that's a great question. So the observation, I'll just repeat it, is that there seems to be a lot of what they call in the crypto industry rug pulls. Basically, someone says, hey, you know, I have a real legitimate project here, buy some of my tokens, and they just pull the rug underneath from you, and you're like, oh, and they disappear and run away, right? And, you know, that's considered theft. It's considered sort of illegal, but who regulates these marketplaces? So I don't know if you had a lot of experience in cryptocurrencies. In 2017, we had a lot of ICOs, and it was very similar. It was these organizations that put up a website and a white paper. They would raise cryptocurrencies, exchange their tokens for either Ethereum or Bitcoins, and they just disappear, okay? So recently we've had something called the DAOs, Decentralized Autonomous Organizations. It's very similar to what was happening in the ICO lands in the 2017. Basically, there's an organization of people coming together. They're going to do something. There's going to be value holding this thing. But then when people start to sort of trade it, they also have Twitter and discourse channels, and they have these social media managers who really promote this stuff, right? And so by and large, a lot of those were not as successful. I'll give you one example. One DAO that I was watching, it's called time wonderland. And what's so interesting about this, the treasury of this decentralized autonomous organization was over $1 billion, okay? So imagine the treasury is $1 billion. The person who was managing the treasury, I'm not making this up, the person's name was Shifu, 0x Shifu, like in Kung Fu Panda, Master Shifu, remember? So Shifu would not reveal himself. It ultimately happened to be a person, right? An actual person. But once people figured out who Shifu was, and this person was, caught up in another scandal, everyone just started dumping, these tokens, right? And people lost money. But I think what's important to understand is who's actually trading these cryptos, right? It's not the person who spent their whole lives accumulating millions of dollars legitimately. It's people who've been mining Bitcoins and Ethereum, and then all of a sudden the price went up like this, and they're sitting on $20 million or $200 million, right? And they're the ones who have this sort of new, let's say, gained wealth through this technology. And they're the ones who can buy a Beeple NFT for $69 million, right? It's not the traditional entrepreneur or people who've made their money in traditional industries that automatically just put $69 million on an NFT. So that's important to understand. And I think sometimes that gets confused because the numbers are so high and people are like, oh yeah, you should definitely regulate these things. But it's also proportionally how many other crypto assets do you have and how much valuations did you capture in a very short period of time. So I hope that answers your question. The other question is about regulation, right? And I agree that we should definitely put guardrails down, 100%, right? The US should definitely take the lead in laying down the best guardrails. That's the onus is on us. And I personally think the US should take a leadership role in cryptocurrencies, the technology, the regulation aspect of it, and so forth, and just keep that. Okay, does that answer your question? What do you guys think? No, let's open it up. Any other thoughts?
Can I mention one thing? I think some of the biggest scams last year were these cross-chain thefts that occurred, and so there's difficulties when you have cryptocurrency on one blockchain and you want to transfer it to cryptocurrency on another blockchain. Doing that in a decentralized way is harder than doing transfers within a blockchain, and it's where the most risk occurs. And so I think two of the biggest instances where people who were acting normally without taking any excessive risk actually had gigantic amounts of funds were stolen. And I think would be the primary place where people should be careful is in these interchain transfers. But then I think there are quite a few scams where people con people into giving away their private keys. And I would just say, I think if you're on the blockchain proper and not in a centralized exchange, then it is sort of the Wild West. And there are no guardrails, and quite a bit of the funds do get taken that way.
There have clearly been a lot of scams in this area. I mean, the whole concept of blockchain is if you get 50% of your miners or validators to decide that something is correct, it's easy. Then it's correct. So the easiest way for a blockchain to be corrupted is for 50% of those people to be corrupt. And I used to worry about this when most of the miners were in China, but now they've all been thrown out of China. And a lot of them have migrated here, and I think that's going to be regulated. But when you're talking about cryptocurrency and losing money, just recognize what Bitcoin really is. Bitcoin is nothing. Bitcoin is though people took the air in this room and put it in a bottle, and everyone perceived that was valuable. There's nothing that stands behind. It's a bubble. And the cleverest marketing thing that happened in the last couple of years is when some great Bitcoin person had the idea of actually putting on the internet a coin with a B in it to make it look like it was something, because it's really nothing. So, and that's the gold standard here, Bitcoin. So when you get to some of the more extreme products, then the risk just goes from there. It will be regulated. Stable coins are a little better because technically there's some currency assets backing them, although you don't really know right now. People aren't very good at disclosing exactly what those assets are. You don't know whether they're highly AAA rated securities or whether they're the lowest rated form of commercial paper. But you've got to be, it's an unregulated area, and caveat emptor. I think that's the rule.
All right. I apologize. We're going to have to wrap this up, but by all means, come ask your questions to us afterwards. So I'm going to kick it over to Jamie. But I'd first like to thank Alessandro, Howard, Brian, and Nicola for their wonderful responses and participation on this panel discussion. Thank you very much.
Thank you all so much. I'm so sorry we're out of time. We are so thankful to our wonderful panel today and for all of you for attending. We encourage you to explore our lifelong learning options, including Hopkins at Home and our Odyssey programs on events.jhu.edu. And also, if you have any questions about our programs or would like to talk to our panelists, we'll be around afterwards in the lobby behind you. So thank you so much. Have a wonderful alumni weekend.